Okay, good morning, students.
Morning, sir.
Okay, am I audible to you people? Can anybody respond?
Yes, sir.
See, response should be very fast. Any of them, please, I request you people, while I have any confusion, the same thing I'm repeating you again and again in the classes that, whenever I ask you to respond, at least unmute and respond, stating that, yes, I'm audible. Huh? Otherwise, I will be just taking the class and any disturbance is there, I think it will be a loss for everybody. Huh? Okay. Should we start the class?
Yes,
Yes, sir.
sir.
Okay, fine. Anyway, this is not so much important as per your syllabus. Okay, but the thing is, I thought it is something very interesting one which has to be known by you people regarding financial strategy of the retail management. I mean, especially when it comes to retail management. Fine. So these financial strategy almost what you people have studied into your FM subject, right? So you people, many of them are very specialized in financial field. Okay, from my side, as a marketing professional, how much it is possible to make you to understand this, I will be trying it better. Okay, so this will be like a brushing up session on financial strategies what any retailer will be using. Okay, and the deeper side, I will be asking any one of you, whosoever is interested, anytime, whenever you people are prepared, can go for in-depth explanation about this chapter. Okay, you can present in the group. Okay, as and when it is required, and anybody who has an interest into it. Otherwise, maybe a short, note what I'm going to give you today. Okay, a very precise description on financial strategies will be helping you people to understand the minimum basics which is required for any retail professional. Okay, fine. Then should I continue with the class now?
Yes, sir.
Okay, fine. So today what we are going to discuss is in your module 3. Okay, okay. Formally, I welcome you people all for your module 3 retail management class on financial strategy. Just let me remind you people that I have dealt with your market strategy, which was very basics about your entire module 3. Among that, this is also one financial strategy which has to be known by us as well as any retailer who wants to be into that particular industry. Okay, fine. As we people have discussed, your basics of retail market strategy has been also dealt. Today we are going to discuss on financial strategies. After that, we go with retail locations, human resource marketing, I mean management strategies, then IMS. Okay. Then also we are going to going with customer relationship management. Okay. As if now for the today's session, I think financial strategy will be a very prime that we are going to concentrate on that, and I will be discussing the same. So when we are talking about this retail strategy, no, financial strategy, the major objective of any retailer will be like the finance, then societal objective as well as the personal objective. When we talk about this financial objective, it will be something that not necessarily that how much you people are going to gain the profit out of making a business in retail industry, but also it is very much important to know that how much the return that you have received on the investment what you people have done into the retail business, that has to be kept in the mind. How much you people have invested on that, how much returns are going to be there each year or any time specific, maybe upward where that you people have set. Okay, that will be a major prime focus. So return on investment is very necessary. Okay, along with the profit. So we have societal objectives, something like after that financial objectives, which will be helping the world around you. Okay, on the basis of how best you people bring improvement into the lifestyle of the people. Okay, and also how much contribution that any retailer as a business, I mean, as a businessman or as a business, how much best you people are contributing to the society and its development. And also we have some objective like personal objectives where the self gratification, what we say, self fulfillment or maybe a self satisfaction of a retailer. Okay, by providing something of value to the society and the people associated into the society for its own business. And for the respect they do for status, okay, the business are going to be run. Okay, these two things we have to know when we people are going to work on understanding how best we people can increase the return on investment what we people have done. Okay, in the business. One, net profit margin and the asset turnover. These two things are very much important. Okay, in understanding and also increasing the return on investment. When we are talking about this net profit margin, no. Here, this net profit margin will be something what net profit divided by the net sales. Okay, so these two things will be constituting your net, okay, sorry, net profit as well as your asset turnover, right? So this net profit into asset turnover, if you are going to multiply both of them, you get return on assets. So whatever the return that you get on assets will be something constituting the net profit divided by your total assets what you people have for the business. So when we're talking about this profit margin, so this profit margin will be something like like net profit divided by net sales, okay, which will be helping you people to gain what is the profit margin that each business is going to get. And what should be the turnover, how the asset turnover happens. This asset turnover will be calculated on the basis of how much net sales has been done. It will be divided with the total assets what any business is having. So ultimately what happens, this profit margin what any businessman is gaining out of the sale, and what is their turnover of an asset will be constituting the return on the assets. So here we have a formula, like certain components we have for any this strategic profit model. Okay, something is very bigger one. Okay, we'll go one by one once we deal with each part here. So the entire module has been divided. Okay, how do people calculate? As I told you in the previous slide, where the return on the assets can be calculated on the basis of the net profit, how much you have gained, will be divided with the asset which has been turnover. So here net profit after the tax, what remains will be added with the net sales. Okay, so that will be constituting your net profit margin. Fine. And when you're talking about assets turnover, that can be calculated on the basis of how much net sales has happened plus what is the total assets of the business what has been invested, okay, to run it. So if we see here as an example, like any strategic profit module for any profit management. So what net profit margin can we calculate? Like maybe sales which is been 100. Okay, the sales which has happened 100. Okay, and what was the cost of goods sold was 60. So ultimately you take it as an expense which is incurred at time when the sale has happened to sell the product. We were 60, which we are going to minus with the I mean, sales will be minus into the cost, whatever expense. What remains is your this 40. So this is something a gross margin which includes, okay, both of them after minusing it. Okay, along with that, what we do among that, we are going to minus total expenses which has been incurred. So what happens in the gross, we are going to minus this total expenses, we get a net profit. So this is a net profit. Okay, now what was the sales? It was 100. Fine. Okay, now 100, we are going to, what we are going to do is whatever sales has happened and what profit has happened. So that net profit will be divided. Okay, the net profit will be divided with the total sales. So you get a margin of 15%. So this says that the net profit margin for any business what they have done. Okay, after selling the goods, they have received how much? 15%. Okay, this will be something like your calculating your net profit margin. So next we have the asset turnover. Okay, because see what was the formula here? Okay, the profit margin into asset turnover, it will be leading to your returns on the assets. So one, we have calculated this. Fine. What is that we have calculated is? Okay. So this has been calculated. Now the remaining is what? How the asset turnover can be calculated. This is how we do. See here. So asset turnover, how we do? One, there are three things which we are going to add. Okay, whichever were the the expenses which has been incurred. One, the inventory. Okay, the first is the inventory. We are going to add with the accounts whichever is receivable. Okay, and also what is the other current assets which has been already calculated and kept into your company's balance sheet, that will be done to the costing, right? So once all these things are get, you are going to add them. So add all the three, you get what is your current asset of a business. So that will be added with your fixed assets, which will be directly leading to the total assets. So total asset is what? Your current assets, okay, plus your fixed asset. Fine. And once the current total asset is being calculated, you borrow the information how much sales is happened. Okay. So now the same, the sales will be divided with your total assets. So what happens? Your asset turnover will be 2.5. Okay. So here it is. See here. Till the sorry. Okay. See what we have done here is we calculated net profit margin, which was 15%. What we say, no, net profit divided by the sales. Okay, and the asset turnover has been calculated at 2.5. Okay, now by doing what? Total sales will be divided by your total assets. Okay, by this. So what happens now? Net profit margin divided by your I mean into, we say it as into, no, okay, net profit margin into, okay, your asset turnover. So this will be your return on the assets. 3.5% will be your return on assets. Here the question arises, if margin is more or less for any business. We have an example here which has been taken by from your referred book. Okay, a textbook which has been given by the university Levy. Fine, retail management. Okay, before going to this, please keep in the mind your net profit margin into the asset turnover will be leading to the return on the assets. Okay, here it is. Here's an example here we have. Okay, see the way the profit has been return on assets has been taken. See, here is a bakery and a jewelry. Okay, net profit, as we people have told, net profit margin, okay, and the asset turnover which has been already calculated. For bakery, it is how much? 1% will be a net profit margin, and 10 times it will be a asset turnover. So ultimately, our returns on the asset is 10% only. If you make it reverse now, for jewelry, the margin is 10%, but asset turnover is very less, one time we say. But still, the return on return on assets remains 10% only. So here the question arises whether the net profit margin is high or less. Okay, the asset turnover ratio, how much times it is going to be calculated for any business, that ultimately that will be linked to certain amount of a certain percentage of return on assets. So this is something like a uniqueness where Okay, whether it is 10 times or 1 times or maybe 1% or 10% net margin, it's very challenging for any retailers to calculate, okay, and set, okay, to understand how best the return on asset can be done. Fine. So this is an example where we have here, okay, some income statements for Federated and department store and Costco. Here, this is what you people see, in your almost cost sheet. Fine, net sales. Okay, and we are going to, okay, see here, net sales we have. So we are going to less the cost of goods sold, then we get a gross margin. Fine, this is a gross margin. Okay, in the gross margin, what we do, we to go through your net total profit after tax or before tax. What we do, we less the operating expenses and any expenses which we are going to incur on the interest ultimately. So we are going to get total expenses as this. We are going to add minus them, then we get the total expenses 5,000 211. The same thing we are going to do with even your Costco also. This is what you people can refer and go, right? So ultimately these taxes will be there, less the tax, then you get a net profit after the tax, which we are going to use it for calculation. Now we have a gross margin here, 40.15, and somewhere here for Costco it is 12.5. So what we do, expenses, the operating expenses, we are going to minus it, fine. Then whatever the percentage net profit after tax, everything is calculated. We use this income statement, okay, for calculation. See here, here it is. The same, the profit management part for both the companies, okay, both the retail giants. What we have here, see here, the net sales we have around 15. We have taken it from the income statement, okay. So this red one will be for Federated and the green one will be for Costco. Fine. So same thing we do. Net sales we are going to minus 9,297 from the 15,630, which is a net sales. Then we get a gross margin. Fine. Fine. And how the total expenses are calculated? What we do? We add the 1 minute. Okay. Fine. Okay, what we are going to do here, we are going to add this operating expenses and the interest expenses, which will be getting the total expense after calculation of both. Then what we are going to do, we are going to minus the gross margin, okay, total expense into the gross margin. Now we have the net profit before the tax. Once the tax is minused, okay, from the net profit, we get net profit after the tax. How much? Around 689. Okay, you take in $1 million or $1 billion, okay, and anything whichever you wish to, okay. And what we do, this net profit after tax will be added with, okay, sorry, it will be divided by your net sales. As I told you, in the last 40 divided by 60, okay, something like that. I mean 40 divided by 100, maybe something like 4.4% will be your net profit margin. So the same thing, the same income sheet we are going to take to understand. Whenever you people see, the gross margin and the cost of goods sold, when we are talking about total net sales, this will be a gross sales. Okay, this will be a gross sales, which we are going to minus into your total, net sales, which remains after lessing the returns, lessing the customer allowances, etc. The same thing happens with your the cost of goods sold as well as the margin what you are going to gain. So this includes all the expenses which you people incur in producing the product and doing it. But when it comes to the gross margin, it includes even some expenses of selling and distribution also. So after that, deducting everything, you get a net margin. Okay, here it is. We have an example. This is the same. The amount which I am showing you on the screen, those amounts are taken from that income statement what I showed you people. Fine. Okay. Now here we have, okay, what gross margin, how it has been calculated. See here, the gross margin, okay, net sales divided by net sales. Okay, the federal, see here, it is something like 40.5% is a gross margin, and for Costco it is 12.5. Now the question comes here is, why does the Federal have a higher margin than the Costco? Okay, one. And second is, if you go to the income statement, you'll come to know where their gross margin is 6,333 dollars, and the net sales is very high. Fine. So ultimately, a certain amount. But when we are talking about your Costco, here the net sales is high, okay, than the your Federal. But thing is, why is so much of difference? Maybe it includes certain expenses which has been reduced by the Federal. Okay, those expenses are good enough in reducing certain expenses which will be adding to their profits. The second is like, does the higher margin means the Federal is more profitable? Now this is a questionable one. Margin is very high for Federal. Okay, see here, 40.5%. Okay, and for Costco it is 12.5%. Is a a unique thing which we have to discuss now, because the high margin, it doesn't mean that they will be having a huge profit. So what expenses what those people have apart from this also can be seen here. Okay, more the expenses, like more assets those people have, managing those assets requires human resource, machineries, the utilities what they use, okay, etc. So sometimes on the basis of the requirement of the retailer, okay, if the requirement is high to maintain the infrastructure, probably because of that also, though the profit margin is very high, okay, but the expenses also included in that. After that only you are going to get your net profit or a margin. Fine. Here, certain operating expenses, as I told you, people know where operating expenses will be divided by the net sales, and you get a percentage. How much percentage of operating expenses those people have to deduct from the profit what they get. And also we have some taxes, types of retail operating expenses we have. As I told you, um, the cost of goods sold. Okay, certain things we have to minus, then you get a certain gross margin. Here, see, as selling expenses we have, which includes what? The sales staff salaries, okay, plus the commissions which has been paid to them for their sales, and the benefits what you people give to a salesperson while selling the product, okay. And we have general expenses, like as I told you, maybe a rent of the shop, and the location, what the utilities, what you people are going to use, the miscellaneous expenses like to run basic operations in the organization, like staplers, EV pen, paper, fine, printers, etc. Okay. Then we have some administrative expenses like giving salary to the employees. Okay. Other than the sales people, also we have operations of buying certain offices which is required to which will be used, okay, in performing the task. Then we have other administrative expenses which will be included to your total administrative expenses. Okay. Fine. So we have something like net profit, which we are going to we are going to use certain formula like net profit divided by net sales, which people have already dealt into your costing and FM, right? Just brushing it up. Please go. Let me go through it. Net profit divided by the net sales. What you have is something like you get a net profit margin in a percentage. Fine. For Federal it is how much? 4.4%. Fine. And for Costco it is 1.8%. Please, for these okay, for these amounts refer, okay, refer the income sheet what I have showed you initially before starting this section. Okay, fine. So this is what the net profit the Federal has, and the net profit of Costco has. Fine. So we have next, like asset information for both of them here. Now I think we have to calculate something like how asset turnover has been calculated in the balance sheet. Fine. Some asset information we have, like accounts receivables, merchandise inventory, cash, the other current assets, and also we get a total. Sorry. Fine. You get a total. The current assets what you have. Okay. What is that? Here. 5,000. Sorry, 7,510, which will be adding all your accounts receivables, then the inventory which those people are holding, how much cash those people are having, and any other current assets. Okay. Then we have like total assets will be calculated after adding both of them. What are those? Total current assets, okay, plus your fixed asset. This will be your total assets, something like 14,885 million dollars something. And we have like inventory turnover. It's 3.0 for federal, and for Costco it is 11.6. Okay, and asset turnover 1.1, and for this Costco it is 3.2. So return on asset will be 14.4.6, and 5.8 percentage. How it has come? See here. Okay, these are the formulas we people have. As I told you, people know, like whatever the accounts receivables are there, okay, that has to be taken. Plus you are going to add the merchandise or inventory what you have. Then you can add cash what you have in your hand, and other any assets, which will be totally calculated as your total current assets. Okay, what I'm going to do is, in the total current asset I'm going to add this fixed asset, which will be constituting total asset of the retail organization. Fine. So what I do now, once I get this total asset, what was my net sales? This. So the net sales, okay, will be divided by your total assets. So this is what it is, both of them. Okay, this your net sales, okay, will be getting divided by the total assets, which we say in percentage. The asset turnover of CR, the federal, it is 1.1%. Okay, and for it is Costco, it is 3.2%. Fine. So this is your asset turnover percentage. Fine. Okay. So here it is. The inventory turnover, how you people do, as I have told you, cost of goods sold divided by the average inventory, what the both the companies are having, which will be giving you an amount which we can understand as a inventory turnover. So it is something 3. Sorry. It is something 3.0 and 11.6. Fine. So you go through the balance sheet. What is the cost of goods sold, and what is the average inventory those people keep? Okay. On that basis, you people can calculate the inventory turnover. Okay. See how it is. Somewhere it starts from this is what is the value system, where something comes from the manufacturer, then it is going to be kept into your stores. Fine. And later on that will be moving to the customer. So something we say it as it's an inbound logistics. Okay, inbound logistics, and it is outbound logistics, which are also influence your supply chain management, where how best you people can procure the material from the different suppliers and the manufacturers, and how it are going to display into the shop. Okay, and what is that average inventory which will be always kept into the here. This is the average inventory which will be kept into the shop. Fine. And how best you're going to turn it out, I mean how best you're going to make a turnover of it, will be helping you to calculate your inventory turnover. Fine. Now we have asset turnover, as we people have also discussed on, like a net sales divided by total assets. Fine. So this is what asset turnover for the Federal is 1.1, and as I told you, it is for Costco it is 3.2. These figures we are going to use it. On that basis we can calculate. So ultimately, what is the return on the assets here? Net profit margin into asset turnover. Okay, you just remind your first first third slide of this class, okay, which was telling you about the same, how the return on assets can be calculated by multiplying net profit margin and the asset turnover. So to come to this, all these calculations we people have to do. Fine. So once the calculation has been done, fine, ultimately see here, net profit margin and the asset turnover both. So ultimately you get what? Return on assets. So this is what we people have intended to understand at the end. Return on the assets. Okay, so we are going to multiply the profit margin, okay, and asset turnover, ultimately, which will be leading to your return on assets. Okay. Okay, this is what the ultimate goal of the financial strategy was, to know how best the return that people have received on the assets what people have invested into a business. Something like here, see 4.3 4.63 for your what is that, federated one. Then we have Costco. This is something like which is having a return on assets for 5.84. Okay, fine. So ultimately, this is the formula, the strategic profit model. Okay, as I told you, from your to calculate these two, which is the major one. Let me tell you. Okay, fine. The major one is what we have to know, this as well as these two. To do all these things, this is a reverse engineering. Go back and find it, okay, and then come to the conclusion. What is the return on assets? So this is what the profit management and the assessment. These two things are very much important for any retailer, okay, to get the his return on investment on any, I mean, into his total business. So managing the assets and managing the profits are very crucial thing which any retailer has to take care. Okay, fine. So we have something like till here. Okay, I think till here it is more than enough to brush it up. I think in the next coming slides I will be expecting any of you people to present it. Okay, next time. Okay, whenever the people are getting prepared with the concept what I'm going to tell you today. Fine, because this is purely a financial thing. There are many students who are good at finance, what I heard from the other faculties. Okay, so I request you people, any of them can take initiation and work on this and present the same thing to everybody. Okay, so next what we have, like productivity measure, how we are going to measure the productivity. If you just remind your first semester management class, okay, productivity where less input and more output, having more efficiency and effectiveness in the job what you people do. On that basis you people can expect productivity. In a very simple understanding, all the time we used to say no, very less input should be there and more output. So this means that with the less expense getting more profit. So how we people are going to measure the productivity? One, on the basis of input measures, which we are going to understand it on the basis of any resource or money which we people are going to use as a retailer in achieving certain outputs which has been already set before. Maybe an example like sales. This is what the particular amount of sales or maybe units of sales should happen for certain specific time period which has been set. So that is the goal. For that output, what resources has to be used and how much money has to be invested in, bringing that. For example, like maybe you are going to invest into some promotional activities, you are going to invest into advertising, fine. So that includes even extra expenses which you people have to decide upon. Resources like human resource, using certain technology, okay, to push your product in the market, making it more convenient for the customers to reach. So those all things will be included. And when you're talking about second measurement of the productivity on the basis of output, this will be something like you are going to calculate on the basis of the results of any retailers on the basis of investment decision. So ultimately, for what purpose it has been, invested a business, or invested money into certain type of business and with certain, retail business model which has been brought by a retailer, and what is his intention of, coming with the business. So that intention, whether it has been survived or not after, a certain time period which he has set to achieve. So on the basis of that also. So altogether we say it as output measurement. So when we are talking about this productivity measurement, which will be determining the how any effectively a retailer uses his resource, sorry, efficiently as well as effective. Both has to be there. When we are talking about efficiently, which is something with the very shortest time or less time, more output. So something, a resource like a time and a money will be saved here. When you are talking about effectiveness, that how best any you take any job, for that job or a task to accomplish it, what is the right amount of resource which is required at the right time to the right moment it has to be invested. So sometimes it depends on that also. So productivity depends on efficiency and effectiveness both. And what was the return that any retailer has got, on the investment what he has done into the business? Okay, and how do people, set or measure the, performance objectives? Very simple one it is. When you people, take or any retailer who will be better, and able to gauge the performance of his business, okay, with certain specific objectives what he has set, and he will be comparing with the certain standards, okay, or criteria which he has set, okay, in his mind. So what should be there? It should include some numerical index of performance desired. If you just recall your financial management like NPA, some amount you people calculate, no, right? Net present value, NPV, sorry, right? Am I right? No, NPV, net present value. Can somebody respond?
Yes, sir.
Okay. See, when we're talking about numerical index, no, you take an example like you are going to invest. Today you have around say 200 rupees with you. Okay, this is 2020. Okay, and you set a certain time period and some amount or number you people fix. Now today it is at 200 rupees a number, and maybe in 19 not let us not take 19, say take it as 2011. Okay, in 2011 you set a number like 100 or 100 rupees. Now today in 2020 it is 200, and it which was invested like 100 in 2011. So altogether 10 years it is. For this 10 years, okay, the percentage which has been grown is 100%, because 100 plus 100% of the 100, how much it is? 100 is equal to 200. So something, if you see, calculate it and see, now the 100 rupees has become 200 rupees today. Now that's the value, right? How best the incremental value has happened. Now this also depends on that. Today, what the retailer invests in amount, what will be the value of that amount, okay, in our coming some certain years, what he has set as a measurement timing. Okay, then time frame, as I told you, for the performance, and the necessary resources which will be helping him to achieve his objectives. So altogether we are going to set and measure the performance objectives towards this. Okay, and while we are setting objectives in a large retail organizations, they come with like a top management, from the top management to bottom, where the top management will be having certain corporate strategies which we are going to develop in the topper positions with the people who are responsible for that, and later on they come to a decision with the research what those people have done, and the information which has been furnished to those people from the related people who take it from the market, okay, or the industry. On that basis they will decide upon, okay, what should be their type of objectives, like in on the basis of category what they have to include, the departments what they want to have into their retail shop, and the sales associates, means like your human resource, fine, ultimately who will be helping you people to implement the strategy which has been developed in the top management. So that's what arrow comes down, like from the top till bottom, the strategies will be flowing, and the decisions what they have taken from the top management, the same decisions will be implemented. Okay, in any functional department or any below departments. Sometimes it happens like it comes from even bottom up approach also in the large organizations, where the bottom up planning we say it as. Okay, here it was like a top down planning. Okay, the second, like bottom up planning, where the information comes from the below people who are working directly with the customers and who are into real markets. Okay, on the basis of their knowledge and the information furnished by those people to the decision makers at the corporate level, will be helping them to decide upon. What is that in reverse? The corporate people or the top management will be deciding upon, okay, certain categories, departments or resources which has to be invested into a particular market at particular location. Okay, so this depends on what buyers and the store managers will be estimating what they can achieve. So something, the strategies and the objectives will be set on the basis of the requirement of the buyers and as well as the store managers. The buyers will be indirectly, influencing the decision of the corporate people who are in the top. And sometimes what happens, operation managers must be completely involved into this while setting the objectives. Okay, for any large organization, retail organizations, fine, who is responsible for. So somewhere, these operation managers will be giving a green signal or giving authenticity to the corporate people that okay, exactly what is happening at the bottom, okay, is right or wrong, can be considered or not. So any financial performance of retail, the retailers will be something like outputs, okay, outputs on the basis of performance, like sales, how much they have done, okay, and in terms of you take it as a unit or in terms of money, okay, then as I told you, like profits, then we have like cash flow, how much is happening, growth in sales or profits, same store, sales growth, or maybe some other stores if they have their own chain of retail. When we are talking about input used by the retailers, even that can also be helping to understand the financial performance. What is the inventory, what those people are keeping. This square feet, what we do, certain retailers will be calculating their profits on the basis of square feet. Okay, each department as well as how much square feet those people are using, okay, in the complete retail location, okay, in that particular shop, even on the basis of square feet. And even employees also, each employee, how much those people are giving profit to the earning is happening because of the employees to the retailer. Then we have overhead like corporate staff and other expenses for administration, advertising expenses, energy cost, which will be the energy which is used to run the business. Fine. Then MIS expenses, like keeping the information and the devices which people are using in managing this information system. Okay, as this has been done, as I told in the last, like very important one to share here is this sales per square feet. Okay, has to be completely understood, because it's a very unique one. Even the calculation of, because this this is something like your asset only, right? Your buildings are fixed asset, and each square foot, how much the building is giving you the profit will be calculated. So that's why sales per square feet and sales per employees will be also calculated to know that how much output has come. Okay, output has come, and what is the input. Okay, given these are the inputs. Employees are the inputs, and square foot is the input. Output will be completely a sales. Fine. So somewhere like these things has been already dealt in your last slides, previous slides. Fine. So these two things has to be kept in the mind. The square feet, sales per square feet, and sales per employees. So the same thing is here. The brief summary of that. Okay, in a single slide you can go through. Fine. Okay. So these things you can use it and understand for the calculation. It has been given year by year, and you can refer it from your Levy's books also, right? Retail Management by Levy. Fine. Okay. So this will be your precise information on financial strategy. Not much questions maybe coming out of this topic, but it is important to understand for everybody, right? Because into your syllabus it has been given just a financial strategy, and maybe little introduction or something like about productivity I can tell, but still I found that it's very interesting one. I was little fast in this, but what to do? The time frame is very less given by the university, but which is very much important to understand for anybody who wants to be into retail business. Fine. Okay. Okay, only 12 members are there today. Okay. Any doubts you people have? Okay. One thing I want to make you clear that if anybody is having interested in want to continue with this same topic, who are good enough in finance, financial analysis. Okay. and I expect that each and every financial term, if they wish to explain what comes under that particular head, subheads. So I will be very happy. Okay, that you people can please present it to all of us. Fine. So open invitation to everybody. Anybody who wish to do, they can. Fine. Okay. Any doubts still here on basics?
No, sir.
Okay. Fine. So shall I wind up the class? Shall I wind up the class?
Yes, sir. Yes,
Yes,
sir.
sir.
Okay.
Yes, sir.
Anyway, it has been noticed by everybody, all the faculties here, that a few people enter the room, okay, your meeting room. Within few minutes, they go out. Just for the sake of attendance, those people do it. What I heard from everybody. Okay, so I request that don't do that, and be present for the entire class, because your participation is so much important for us to get motivated and take some better classes for you. I know it may not be so much effective enough over the this type of platforms, but what to do, due to a pandemic situation of COVID, there's no other way. I think something is better than nothing, right? So something it is here. Probably if offline classes will start now, we can do better than this. Fine. Okay, good. All of you have a nice day. Bye bye.
Thank you, sir.